Ever find yourself offloading profitable investments while obstinately clinging to those that are underperforming? This is a common predicament, often driven by loss aversion bias, a reluctance to come to terms with losses and move on. But imagine if those winners you let go of keep on flying high, while the losers you're holding on to keep sinking, particularly when their underlying fundamentals are deteriorating. Or perhaps you find yourself hesitating over decisions due to a fear of regretting them later, based on past experiences. This could be an example of regret aversion bias, which can result in an overly cautious approach, or a tendency to follow the crowd. These emotional biases can often go unnoticed, yet they have a significant impact on decision-making and outcomes. It's crucial to understand these biases. By identifying them, we can take steps to reduce their influence and make more informed decisions. Imagine becoming attached to a product after a free trial and subsequently buying it. This is a tactic that sellers use to exploit the endowment bias. Also known as the ownership effect, this bias causes people to view items they own or potentially own as more valuable. The endowment bias arises from our inclination to favor things that we associate with ourselves. It overlaps with loss aversion, causing distress over potential losses. In the world of investing, those affected by the endowment bias may be reluctant to switch out poor-performing stocks, hold on to mediocre assets, and turn short-term trades into long-term positions. This can result in an overvalued and mismatched portfolio. To counter this bias, investors can consider the opportunity costs and reassess their investment strategies without any emotional attachment. Now consider how confident you are that your investments will outperform the market average. If you're overly confident, you could be experiencing the overconfidence bias. This bias can manifest in two ways: overestimating your knowledge or your ability to access information, and self-attribution bias, giving yourself the credit for success while blaming others for failures. Investors swayed by overconfidence tend to ignore risks, overestimate profits, lack diversification, and trade excessively. To tackle this bias, reflect on past decisions, seek objective opinions, and consider alternative viewpoints. Remember, emotional biases can pile up, leading to larger losses. Regular portfolio reviews and adjustments based on objectives are key to mitigating these risks.